So let me open up, and I'll open up with yourself, John. So my first question is, in your view, how will changing capital requirements and market forces affect premiums in different product lines as we go forward?
I'm a bit of a cynic on changing capital requirements because for as long as I've been in the industry, the capital requirement for personal lines was roughly 30% of premium. And having gone through all the iterations of Solvency II, guess what we get back to? 30% of premium. So I'm not sure it's going to make a huge difference. It does cause you to recognise that household insurance and SME insurance is more capital intensive, so roughly 40% compared to roughly 25% for car insurance. But forever and a day, we as an industry have cross-subsidised for commercial opportunity, and I don't think that will stop. I think we'll recognise it costs 40% to write household, but we will still price it as if it costs 30% if there's a commercial opportunity to be had.
Okay. Clement, you got a view?
In principle, Solvency II should, when allocated by line of business, should have some impact on the inherent cyclicality of the market. But I kind of agree that over the last years, in its various iterations, since we go back to the 70s and now to a later version of how to calculate the cost of insurance, that what we've done mostly is become more scientific about doing the wrong thing. So we sort of analyze to death, but then in the end have a system of discounts which take us back to where the market lies. So in our organization, I often say I don't care about the cycle because this is not going to come out and save us. And in fact, in the last 4 decades, there's only been really one important cycle which affected all classes of business, and that was post 9/11. All of the other cycles were either regional or focused on specific product areas. So if it's not cycle that's going to save us, I don't think it's Solvency II either. Well, if you really want to find a way to compete, and by all means compete, it's not bad for the consumer either.
Okay, thank you for that. What about yourself, Amanda?
I don't think I've got a huge amount to add other than to say, I think Solvency II isn't going to fundamentally change the way most insurance companies operate, other than it's cost a huge amount of money and a lot of actuarial time to get us back to what I think John said, which is the same result.
Okay, okay. So Amanda, staying with yourself, so something that you mentioned, you covered sort of briefly in some of your slides. So what would be your view in terms of aggregators, claims farming and the uninsured? What do you think must insurers do to address some of these challenges?
Well, I think the AXA position on referral fees is pretty clear. So, and I'm not the expert speaker on that. I think that the aggregator rise, if I talk about commercial insurance, I think the aggregators will move into the commercial insurance space. I think we've already seen the aggregators, most of the aggregators do deals in the commercial arena in the last 6 to 12 months. So they must be getting some sort of traction, otherwise I'm guessing they wouldn't be doing those deals out there. I don't think there's a great solution for them at the minute, but I do think that's an inevitability. As far as referral fees are concerned, I think we need to clean up our act and we need to be clear about what the correct solution is, and I'm sure it will be a source of debate over the next 48 hours.
Okay. What about yourself, John?
Well, perhaps I think Amanda's covered two of the three. Perhaps I should just focus on the uninsured driver element of your question, which is a big problem and a growing problem. And I think one of the consequences of some of the things we talked about this morning, particularly about the increasing sophistication of data and the increasing quality of insights into customer value, there is an unfortunate consequence which is probably going to lead to social exclusion. And the reason that we have 1 million or 2 million people driving uninsured is because, to be honest, they're uninsurable from an economic perspective. So I think it then becomes a political decision for governments. Does the government want to step in and make sure that those people can afford that insurance? But it will come with an unfairness because everybody else is going to have to pay for it to cross-subsidise. So I think it's not a problem that the industry can solve. I think it becomes a political issue. Okay.
So Clem, I won't ask you to respond to that, but I'd like to just sort of move the conversation on a little bit. So I think it's fair to say across all of the presentations this morning, everyone's talked about change, need for change, change in direction, changing markets. What do you think is standing in the way of organisations embracing and adopting and making change in their own organisations?
Well, nothing is, really. I mean, we're making loads of changes. The changes are incremental, of course, because if I take our group, we have north of 1,500 companies around the world. They were all at some stage doing their own thing, and we try to bring this onto common platforms. So the change is not always apparent in terms of the effort to take us from one point to another, but a load of things is going on. Another change that could take place is consolidation in the market. What's holding that up at the moment is that an honest insurer will tell you that they don't yet know what the impact of Solvency II is going to be. In its worst incarnation, quite a serious impact. So this wouldn't be the moment to go out and purchase overpriced assets. And note, I said overpriced assets because we've not seen the bottom of the market yet. I mean, when is it cheap enough to buy? Maybe a change in the broker landscape, commercial lines. I'm cynical or skeptical about whether we'll see a significant shift from brokered commercial business to direct. Might be wrong. I think in the SME field we will, but I think the brokers are far better at relationship building than we are as insurers, and it will take us some time to catch up. So in essence, nothing's stopping change. Don't wait for regulation. Don't wait for Solvency II. Don't wait for customers saying that you give lousy service. You know that already. Just do something about it.
Okay, thank you. Amanda, you got some insight?
Yeah, I mean, I agree. I don't think that there's anything that's stopping change from happening. I do think that there will be change at the SME, the micro trader end. I think that will become disintermediated. I think it's actually inevitable because the people starting up in business, their expectation is that they will buy online. That may be via a broker online, by the way, but you know, I do think that that will not be a telephone-based or face-to-face sale. Once the business becomes more complex, I think that the conversation becomes one much more, which is either face-to-face or telephone-based. But I do think change is happening. I think that the business is not preparing for that will not survive.
Okay. How about yourself, John?
I think it would be wrong to typify the industry as an industry that doesn't change or is afraid of change. In fact, I think the industry itself has moved enormously over the last 20 years. If I think back to a guy that I used to work for, the guy who founded Churchill, he had a phrase which he loved to use, which is that there are three types of companies. There are companies that make things happen, companies that watch things happen, and companies that wonder what happened. And that did describe the insurance industry 20 years ago, I feel, but it doesn't at all today. I think this is an industry which is full of change, and there is no fear of change in the industry. I think it's a very pragmatic thing that prevents further change, and possibly music to the ears of the software consultants in the room. The thing that holds us back from more rapid change is technology and the practicalities of just getting change delivered.
Okay. From an audience perspective, any questions that you'd like to ask the panel? Anybody ready to ask a question? Wow, you guys are shy today. No? Okay, so I guess I'll come back to you, John, again on another question. So do you think we're going to see continued consolidation and change of ownership across the industry, both in terms of general and commercial?
I think I would say actually not necessarily continued consolidation, because I think in recent times we've been through the opposite of that. We've been through a period of fragmentation, not necessarily through M&A, but through organic shifts in market share. So those who had big chunks of the market have now got smaller chunks of the market. But I do think going forward there will be changes in ownership, whether that amounts to consolidation or not. I think external forces will look at our markets, and take RBS Insurance as an example. According to the press yesterday, they've received an offer of £4 billion for a business which has a book value of 4.3 billion, which would suggest there is no premium for the value of the Direct Line and Churchill brands, which makes no sense. So I think these kind of bizarre economic conditions will result in change happening, and I think there will be a lot of M&A activity as soon as the debt markets free up and people can fund the deals.
And within that, do you think that might encourage new entrants into the market space, generally speaking? New players, non-financial in some cases?
Not, well, non-financial in terms of them being non-insurance. I think there will be more private equity activity in the general insurance sector. I don't think there will be pure new entrants, but it could be that overseas insurers, particularly American insurers, get much more interested in owning UK and European businesses.
Okay. What about yourself, Clem?
I think I've talked about the potential for consolidation from the context of Solvency II and other forces, but consider this and think about the airline business and think about your business. A high-cost, low-service model is less appealing than in the past. This is a fundamental departure point from where we've been. You only have to go to Heathrow to figure out which airlines are still providing high-cost, low-service, and how those models will come under strain. And ours will be no different. So we have, in parts of the world, in certain lines of business, up to half of each dollar is being consumed other than in the payment of claims in the industry right now. In other words, for distribution, for assessors' fees, for administration charges, for whatever else. And that's really not good enough. So perhaps the biggest wave of consolidation that lies ahead will be around focusing on delivering service excellence and operational efficiency to our long-suffering customers in this industry. We can't afford any more of the sort of scandals that we've seen recently, and actually this is not only reflected in what I'm saying now, but also in the valuation of insurance companies, which is a kind of all-time low right now, even below the banks. And so it shows that there is a kind of a tidal wave building up. How exactly it will play out, I'm not sure, because right now, obviously, the difficulty would be to raise equity capital. Not a great time to do that. It's a time to sort of, as it were, bunker down and get past the crisis. But for sure, there's going to be a wave of consolidation in the next decade or so.
Okay. Amanda?
I mean, I agree, certainly as far as the broker landscape is concerned. You know, all the dynamics of that landscape haven't changed. It's just that the debt market has dried up. You've still got thousands of brokers in the UK who are at or approaching retirement age, and some of them well in excess of retirement age. Yeah. And at some point, you know, they will have to sell their businesses or they will have to hand their businesses over. I think, you know, the consolidators provided one mechanism for them to do that. That mechanism isn't available at the minute. It doesn't mean to say that the issue's gone away. The issue's still there. So there needs to be a different mechanism for solving it. But, you know, 4,500 brokers across the UK, all average ages of, you know, 60 plus, for over 50-60% of them, it has to be solved somehow.
Okay, thank you for that. Open up again to the floor. Anybody got any questions they'd like to put to the panel? If so, just put your hand up and someone will come over to you with a microphone. If you would be so kind as to give us your name and where you're from, we'd appreciate that.
Yeah, Saxon East from Insurance Times. It's a question for Clem, actually, earlier on his economic outlook. I noticed the Allianz bond insurance programme. Do you think it's doomed to failure because a lack of firepower from the European Central Bank?
No, I don't think so, because one has to look at the alternatives. This program which is being put forward is not a private sector program. We've simply acted as an advisor. And if the line in the sand has been drawn around two key things, the one is that we don't want to see any uncontrolled default on sovereign debt in Europe, number one. And number two, we don't want to see a collapse of a major bank within the system. Then the amount of things that you can actually do to reduce the volatility in the system are somewhat limited, and that certainly should play some part of the role. So for example, future bonds being insured to a certain degree should take some of the speculation out of the system. Now, whether you do it through an insurance vehicle using risk management techniques, or whether you do it just out of the fiscus is entirely up to a political question, but it seems to us that using an insurance methodology which is not dissimilar to the monoliner methodology which you see in the US, for example, or in the trade credit market, seems to make some sense. So no, we don't think it's doomed to failure.
Okay, thank you. One last question. I'll open up to the floor. Anybody got a question? Please raise your hand. Tell us where you're from and your name, please.
Yeah, my name's Graham Johnson. I work for RBS Insurance. I think some mention was made of professional standards, and obviously a while ago we heard about the Alderbury Declaration. Things seem to have gone rather quiet. Is that right? What more should we be doing?
Amanda, would you like to start with that one?
I'm happy to answer that. No, I don't think the Alderbury Declaration has gone quiet at all. In fact, you know, there are more brokers and insurers signing up to the Alderbury Declaration all the time. Sandy Scott is in the audience, and I'm sure that his team will be able to give us the exact numbers. And the number of chartered brokers and chartered insurers is increasing, and what you're seeing is that the bigger brokers, the big regional brokers, are going for chartered status and seeing that as an important differentiator. I think that professionalism is a differentiator, and it is really important that we are not forced by the regulator to become professional, that we do that of our own accord and we go through the process of doing it. So the Alderbury Declaration is the way of getting through the process towards becoming a chartered broker or chartered insurer. I think it's far from a dead subject. I think it's a very, very live subject. You know, AXA, we will launch a chartered broker proposition next year because we believe, we've looked at the stats, we know that we make more money out of chartered brokers than we do out of non-chartered brokers. There's got to be something about that.
Okay. So we'll have to do one last question, then we'll have to wrap up. Sorry, to the lady here.
I'm Liz Foster, Managing Director of Ingram Hawkins & Knock, and I'm also a board member of the broking faculty of the CII. And taking up Amanda's point, which I know she stated well previously and I've heard and I'm grateful for, I really would challenge all other insurers in the room to support insurance brokers and intermediaries in achieving chartered status, because I think that is the way in which we're going to achieve recognition and, more importantly probably, the appreciation of the insurance buying public to the profession that we are, rather than the industry that we often talk about.
Okay, thank you. All right, so we need to wrap up and move on, so please give a... Put your hands together for John, Clement and Amanda, and thank you for their time. Thank you.